Hello and welcome to the Business Standard Morning Show. I'm Swapnil Joglekar. Let's take a look at the stories for the day. Gautam Adani may not be the only highly leveraged Indian industrialist in trouble. While it is not facing a Hindenburg-like storm, Anil Agarwal's Vedanta Resources Limited too has significant debt on its books. And one of Agarwal's recent attempts to reduce the debt burden has met with opposition from the Indian government itself. So, is Vedanta in trouble? Bashir Kumar brings you the answer.
Vedanta's plan to trim down its $7.7 billion debt continues to face challenges. In the latest development, an unnamed government official has told a financial daily that instead of handing out cash, Hindustan Zinc Limited should explore alternative strategies for financing its proposed $2.98 billion acquisition of Vedanta Limited's zinc assets. The official added that the government could ask Hindustan Zinc, or HZL, to consider share swaps, warrants, or rights issues for purchasing the concerned assets. The government's rationale is that since it's a stakeholder in the company and has a right to its cash reserves, it will not allow its use for a related party transaction. Also, the Ministry of Mines reportedly views the proposed acquisition as being against minority shareholder rights. The ministry has also written to the markets regulator, reiterating its opposition to the deal. Vedanta owns a 64.9% stake in HZL, while the government owns 29.5%. While much smaller than before, Hindustan Zinc reportedly has cash reserves of $2 billion. So, what are the details of the proposed acquisition? On January 19th, the HZL board approved the acquisition of Vedanta Zinc International assets of THL Zinc Ventures Limited, Mauritius, a wholly owned subsidiary of Vedanta Limited through THL Zinc Limited, Mauritius. The proposed cash deal involving Vedanta Limited offloading THL Zinc Limited, Mauritius to Hindustan Zinc would have taken care of the liquidity needs of mining giant Vedanta Resources, since it owns a 70% stake in Vedanta Limited. But the government's opposition to the Hindustan Zinc THL Zinc Limited deal has put Anil Agarwal's plans to trim down the $7.7 billion net debt of Vedanta Resources in jeopardy. The development comes after S&P Global Ratings raised doubts about the financial health of the group. According to the ratings agency, the ability of Vedanta Resources to meet its financial obligations beyond September will depend on a planned $2 billion fundraising and the proposed sale of THL Zinc Limited. The latter is in doubt, however, as the government-nominated directors on Hindustan Zinc's board have opposed the acquisition. And in a February 17th letter, the government urged the company to explore other cashless methods for acquiring these assets, and even threatened to explore legal avenues if Hindustan Zinc still decided to proceed with the purchase. Anil Agarwal's attempts to secure finances for $1.5 billion in bond and loan repayments between September 2023 and January 2024 have already been hit. The uncertainty has hit Vedanta Resources bondholders and reportedly driven the price of the August 2024 note below 70 cents on the dollar. The group's credit rating, which is already in the junk bond category, could take a further hit if this fundraising doesn't go as planned. So, is Vedanta in trouble?
As such, it looks like the promoter holding company, which is Vedanta Resources Limited, a lot of debt which was taken there to acquire mines or to acquire these mining assets across the world are due for refinancing later this year, due for repayment later this year. So that is the impending reason why Vedanta promoters need to are on the lookout for cash, right? I mean, so, and that is the reason why they would like to utilize the cash reserves that Hindustan Zinc has. The promoters of Vedanta thought that they could use the cash to acquire asset owned by Vedanta itself, so that they can then sort of take the cash out to the holding company, which is Vedanta Resources Limited, and then pay off their debt. So obviously, the government proposition of using either doing a share swap or a rights issue, etc., doesn't help Vedanta Resources at all, because it requires cash to pay off the debt.
So, what is the way forward?
So what will the CFO of Vedanta Resources do? I mean, obviously it will be a problem if they are not able to pay the debt holders, which is the bond holders or other debt which they have taken. So they will have to refinance them at slightly higher cost, or two is they will have to renegotiate with the current bond holders itself and defer it for some more period of time. So the bondholders recognize that Vedanta itself has a lot of mining assets across the world. One, of course, they can sell off some mining assets to third party, probably to Rio-Tinto, etc., if this HZL deal doesn't happen. Because at the end of the day, even here, they are trying to sell off some zinc mines to Hindustan Zinc Limited. So those zinc mines themselves could be sold to some other third party. Obviously, they may not get as much valuation. So the options to the CFO of Vedanta definitely exist, and they will not just default, because there are actual assets underlying which are there.
The fallout of Hindustan Zinc's asset acquisition not going through may be that Agarwal will find raising fresh funds at a reasonable cost challenging under the prevailing conditions. Moreover, as one Bloomberg columnist points out, Agarwal cannot afford to court the central government's displeasure at this point in time, because that could upset his semiconductor ambitions.
While metals mogul Agarwal's plan to trim down debt may have run into rough weather, airlines in India are clearly looking at a clear sky. After navigating pandemic turbulence, they have started reporting profits now. Orders of over 1,000 new aircraft have also been placed, and the airlines are now scrambling to ramp up staffing. But will we be able to find enough pilots to fly this expanding fleet? What are the challenges involved? Debar Gasanel's report has more on this.
Pandemic is slowly slipping into history, and increased mobility is lifting the spirits of airlines. Most of them have turned the corner and are reporting profit now. And buoyed by the growing base of flyers, airlines have gone on a shopping spree too. There is a long queue before the airline supermarket. Air India is in the line with an order of 470 aircraft from Boeing and Airbus. It is likely to cost $70 billion to its new owner, the mighty Tata Group. The airline currently has 140 aircraft. Indigo also looks no less ambitious, with a shopping list of 500 planes. Go First wants 72 aircraft in its cart. Akasa Air is in line to get 56 aircraft, and Vistara wants to buy 17 planes. So with more than 1,100 new aircraft flying into Indian hangars soon, the country certainly needs more trained pilots. The training is extensive and takes anywhere between 22 and 27 months.
So it starts off in the flying school with learning basic theory of flight and elementary flying skills. Over a period of about 16 to 18 months, you will graduate with what's called a commercial pilot's license, or a CPL. Then you go to the next step, you get a type rating on a certain type of aircraft. And then you begin what's called the line training, and that is typically an on-the-job training that an airline puts you through on their specific, not only the aircraft that they fly, but the company procedures, and that takes about 6 to 9 months to complete.
But do we have the required infrastructure to train pilots to meet this demand?
No. Aircraft training is done on simulators. And simulators are almost as expensive as aircraft. In India, we would have roughly around 10 320 simulators, which are still not enough to meet the present requirement. Today, someone wants to become a pilot. For his CPL, he's going abroad because Australia, parts of America have maximum number of good flying days. In India, you don't have many good flying days. Today, there are people who are charging 1 crore plus for a pilot to get a CPL and a type rating. So, who can afford that?
Indian Airlines have long been dogged by the shortage of crew members and pilots. According to a report by news agency PTI, 2 pilot unions at Air India have recently said that there was a shortage of pilots to operate the airline's long-haul and ultra-long-haul flights. The union also reportedly questioned the airline's decision to hire more expat pilots at a higher package. Meanwhile, Air India said last week that it plans to hire 900 pilots and over 4,200 cabin crew this year. Other airlines too are no different. They need more trained pilots to expand business. According to reports, Air India has about 1,600 pilots, and it will need over 6,500 pilots to operate 470 aircraft it has ordered. But the number of new licenses issued every year to trained pilots has been below the 1,000 mark. Ministry of Civil Aviation data says that a total 744 commercial pilot licenses were issued in 2019. It came down to 578 in the year 2020. The number increased to 862 in the year 2021. Until December 6, 2022, 1,081 CPLs were issued by the DGCA. A pilot's training costs up to a whopping 50 lakh rupees before he or she applies for the CPL. And according to reports, India has close to 10,000 pilots operating commercial planes right now. And a senior pilot recently told a national daily that on an average, about 200 pilots have been retiring every year. Pilots have been feeling the pressure of crew shortage and fatigue levels are rising. Industry insiders say they are aware of the situation and steps are already being taken.
The Airports Authority of India has already approved setting up 9 more flying schools over and above the 34 that are already approved by the DGCA in the last 1 year itself. And then in the next phase, there are 15 more flying schools coming up in another 10 airports. What it takes is, one, capital investment, of course. The second, very important, is experienced trainers. And then the third is that the regulatory system has to constantly evolve because newer complex operations, newer type of airports, new type of airplanes.
The aviation sector needs to become more financially viable, not just for future pilots, but also for other crew roles.
So each airline will have to set up its own training establishments. The department, the director in DGCA looking after this doesn't have the skill, doesn't have the manpower. So instructors' approvals are pending for a year. Although they have the facilities themselves here, they've got themselves airports, they've got everything aircraft here, but they can't train because the DGCA is not facilitating. So they're sending people abroad. It's very doable. It has to be fast-tracked. Treat training as a startup. It's not only pilots. A whole lot of people have to be trained. Engineers, cabin crew, ground staff, security staff.
Lumba also points out that there needs to be a fundamental change in the approach to air travel in India.
Don't realize how important aviation is to the mobility of the economy. See, the government has to get out of the mindset that aviation is a luxury. It's being taxed as a luxury. It's not a luxury.
The new purchases by airlines will also include replacement aircrafts for some of its current airplanes. However, experts believe even then the expansion in fleets might lead to a major demand and supply gap if the government and the airlines do not come together to build a more financially viable skill development infrastructure for the aviation sector.
the number of operational airports in the country has risen from 74 to 140 in the last 8 years. From sky traffic, let us now shift focus to the roads. Road and Transport Ministry saw a 36% jump in the budget 2023 allocation, kindling hope that related stocks would witness a good growth in the long term. Experts said that the strong order book and healthy NHAI pipeline bodes well for road construction players. Lovisha Darad's report has more on it.
As the Union Budget 2023-24 allocates 2.7 trillion rupees to the Roads and Transport Ministry, companies engaged in the road construction activities have come under the limelight. Since the Budget 2023, shares of road construction companies like 8G Infra Engineering, KNR Constructions and KEC International have surged up to 9.3%. In comparison, the S&P BSE Sensex declined 0.1%. As the centre sets target to add over 12,000 kilometers in FY23's highway network, analysts expect strong order book inflows to benefit related stocks in the sector.
Union Budget 23-24 has increased the road capex by 36%, which we believe is very good for this sector, as most of the companies in the sector will be in a position to take a good order inflow moving ahead. NHI bidding pipeline is very strong at rupees 1 lakh crore, which also augurs well for the companies in the sector. Further, softening in commodity prices also augurs well, as it will help in margin expansion for these companies, and the competitive intensity has also come down as far as HAM projects are concerned. There are a few companies in the sector like PNC Infra, KNR Construction and HG Infra who are well placed to capture the higher capex in the road sector. These are well-run companies with efficient management, efficient execution, long track record of flawless execution and robust order book and balance sheet. So we should look at these three companies for investment purpose moving ahead.
In the October-December period of FY23, order inflow for road-dependent players rose by 5% year-on-year to 25,700 crore rupees. However, analysts foresee a sharp surge in road awards December end onwards to provide a big fillip to road infra stocks.
Despite a brief lull in awarding in October-November 22, it swiftly returned in December, and the trend is likely to continue leading up to the general elections in 2024. Yet, the fluid global scenario continues to remain the key risk. On overall awarding situation, we have seen a sharp surge in December 22, which ensured robust rupees 1.9 trillion awarding in Q3, the strongest in last 3 quarters. With this, the 9-month awards is scaled up to rupees 5.2 trillion, which is up 51% and makes up 96% of FY22 awards. Such Q3 awards emanated from tenders of rupees 4.1 trillion, which is higher by 52% YOY, which in turn appear to have benefited from strong rupees 8 trillion of announcements. The major announcements from the sectors which were coming were coal, which comes to 576 billion, railways 250 billion rupees, roadways coming in third, 226 billion rupees. Our preferred bet in the infrastructure space is HG Infra Engineering, KNR Construction, NCC, and PNC Infratech.
Against this backdrop, analysts believe that highway awards in February-March would be critical to watch out for. As regards today, market trends will be dominated by India's Q3 GDP data, global cues, rupee movement and foreign fund flow action.
Shares of Adani Group companies recently tumbled after global index provider MSCI reduced the weightage of its 4 firms. But it later postponed the decision to its May review, giving some respite to the conglomerate. Key index providers like MSCI, FTSE and Nifty undergo quarterly or semi-annual rejig of their indices. This is called index rebalancing. We tell more about this review in our Decoded segment.
An index is a gauge of the performance of a basket of securities. For instance, the MSCI India or Nifty or the BSE Sensex indices are the gauges that tell us the performance of the Indian markets. An index provider has set rules and eligibility criteria for formulating an index. Factors such as market capitalization, free float, investment cap, On foreign portfolio investors, liquidity and sectoral composition are key for a stock to qualify. Index providers give importance to sector composition to ensure that the index has a representation of companies belonging to diverse sectors. For a globe index like MSCI India, the broad principles are the same. However, since indices give importance to FPI legroom, as these indices are used by funds outside India. A company that is not part of an index may do so well that it may become bigger than the companies that are part of an index. So, how does that company make it to the index? For that to happen, index providers conduct the rebalancing or review of the indices every quarter. During the review, they assess if a stock or stocks which are not part of their index can dislodge a stock which is part of the index. This is done based on predetermined quantitative parameters like free float, market cap, sector composition, etc. For instance, Tata Consumer Products replaced state-owned GAIL India in the benchmark Nifty 50 index in March 2021. This was because the former's free float market cap had surpassed that of GAIL during the review period. Typically, a stock that gets added to a large index tends to do well, while the one that gets removed tends to underperform. This is because whenever a stock is added or removed from an index, the ETFs tracking the index also have to realign their portfolios. In other words, they have to sell a stock that is removed and buy a stock that gets added. Analysts try to predict which stock will get added and removed based on publicly available data ahead of an official announcement so that they can position themselves to benefit from the ensuing rebalancing of ETFs. FIF is a term used in the context of global indices. As mentioned earlier, indices compiled by MSCI and FTSE are mostly tracked by foreign funds, so the availability of investment room for FPIs is critical. A stock cannot be added to a global index if the FPI investment limit is exhausted or close to getting exhausted. FIF is a key metric which takes into account the actual free float available for FPIs. For instance, HDFC Bank, being such a large corporation, isn't part of the MSCI indices as there is not enough legroom in the company for FPIs.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
MSCI All Country World Index tracks stocks from 23 developed and 24 emerging markets. It serves as a guide for the fund managers to allocate funds. That's all for today. Catch the next episode of The Morning Show tomorrow. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.